Hello and welcome to Business Incorporated, coming to you live from Lagos, Nigeria. I'm Chimeze Obi Iwagu. Thank you for joining us. And coming up on the show, global markets in the red after a stronger than expected U.S. jobs report sent interest rates higher. South Africa's dollar bonds fall, CDS rise on Zuma uncertainty. Plus, a financing initiative in Sudan empowers women in rural communities. Now let's get the show started with the markets. Starting off here on the African continent, the markets followed their global counterparts to trade in the red at intraday, except Egypt. The Nigerian oil share index was down 1.32%, with the industrial sector leading the losses. No thanks to Dangote Cement, which lost 4.46% at the time. South Africa's JSE index was also down 2.22% following the political uncertainty in the country. However, Egypt was in the green, 0.64%, while Nairobi closed in the green on Friday. And in the Middle East, stock markets were trading low at intraday, with Saudi Arabia seeing profit-taking in cement shares, while real estate stocks remained weak in Dubai. The region had already dropped on Sunday in response to Wall Street's Friday plunge. The Saudi index slipped 0.3% in the first half hour, as Tabuk Cement pulled back 2.3%. Tabuk had jumped in the past several days on a media report that the government had started awarding contracts to build a huge Neom business zone in the northwest of the country. Dubai's index was down 0.23%. Emma Properties was 0.3% lower, but construction firm Arab Tech climbed 2.6%. In Qatar, the index slid 1.36%, but Qatar Islamic Bank gained 2.5% in unusually heavy trade. Abu Dhabi was down 0.06%. In Europe, stocks traded sharply lower in early trade as weakness seen in markets overseas weighed on sentiment. Let's bring in Daniel Cook, my colleague in Frankfurt, to give us details. Hello, Daniel. Good afternoon. A beautiful week.
Yeah, good afternoon. A beautiful week, but freezing week here in Frankfurt. We're expecting temperatures tonight up to -10 degrees. So, yeah, hopefully my apartment will be quite hot tonight.
Well, I pity. Anyway, global stock markets, including European equities, are covered in red, in sea of red, of course. Who and what are upsetting the market, if I may ask?
Yeah, investors certainly need very strong nerves today. Already happening this morning at the major indices in Asia. All of them were down, such as the Hang Seng, such as the Nikkei, such as the Shanghai Composite. And this trend has really continued here also on the European front and also here at the Frankfurt Stock Exchange. Right now, we are down still with about -0.9%. We were even a little bit more down. I guess you can see it in the background, then slightly recovered, now again down. Two big issues that investors are here really monitoring. Mostly the strong euro that is again giving investors quite some headache. On the other hand, possible new interest rate hikes from the United States happening there by the Fed. Last week we got very strong unemployment report from the United States, also a report that wages have been going up. Because of this, many investors think that we might see 3, maybe even 4 interest rate hikes by the Fed this year. This is always putting the market very under pressure, because higher interest rates in many cases means less liquidity here for the market. This then could lead investors invest their money not in traditional shares, but maybe in bonds, maybe even putting some money aside on their bank account. That's of course what investors don't like. For investors, it's maybe interesting again in some weeks. We might even see a correction up to maybe only the 12,000 point mark right now. We have to remember that on January 23rd, we even had a record high here at the blue chip index DAX of 13,500 points. Already on Friday, stocks were dropping to 12,700 points. Now the X index of the blue chip index DAX, that's always the index kind of giving you an idea and in which direction all of this is going to go. It's really indicating that the trend most likely is even going to go a little bit more down in the upcoming days and weeks. Let's see.
We'll wait and see. Anyway, a number of earnings are also driving sentiments. Take us through the headline-grabbing results on tap in the Newsweek.
Yeah, Ryanair, the low-cost carrier, was providing numbers today. Investors were monitoring those numbers very closely as they were really eager to know how those strikes, also the negative PR that Ryanair was creating last year and also mostly in the last quarter, how this would be affecting their results. But actually, despite higher costs because of the strikes, they presented promising numbers to investors. Their revenue went up by 12% to 106 million euros. Also more passengers and less taxes they had to pay. Also their sales numbers went up by 4% to 1.4 billion euros. And they also are announcing a program to buy some shares of them back worth of 715 million euros. Ryanair, I mentioned, was mostly in the headlines during the last weeks because of pilots that were rather rebellious inside of the company. Also because of that, we have seen a small strike happening. Now we are hearing that a possible strike could be affecting air travel here in Europe again during Easter time. They only were able so far to get an agreement with their pilots based in the United Kingdom, and also only with their pilots who have a fixed contract. Remember that Ryanair has been criticized also in the past for not giving all of their pilots a regular contract. Some of them are working as a contractor. Many feel that this is sort of a depending contracting, which they are not happy about at all. So the CEO of Ryanair, who is not really known to be that cooperative, he already announced today that those wishes that the pilots have for higher wages, for example, that those are ridiculous. So yeah, we might see another strike period happening before or even maybe during Easter time. But so far, the numbers from Ryanair, at least for the moment, were pretty good.
Right, let's get across the Atlantic. In the U.S., Jerome Powell is to be sworn in as head of the U.S. Fed this week. Any idea what's on his playbook?
Well, we remember that Mr. Powell has been working for the Fed already quite some time. He was working under the leadership of Janet Yellen, the former head of the Fed, and he was mostly in favor of her decision, which means a return to higher interest rates on the one hand. Just when you talk, for example, about regulating banks, for example, there he had a different opinion, so we might see this a little bit more happening. Also very interesting, usually when you have a new head of the Fed, those are normally economists, people with a background who studied something like that also in university. In his case, a little bit different. He actually used to be a university professor. He studied law, so he has a little bit a different background. But as I was outlining a little bit earlier, investors here on the Frankfurt Stock Exchange and also around other exchanges are very sure that most likely we're going to see even higher interest rates, maybe 3 or 4 times during this year. But in general, as I said, he has been under the leadership of Ms. Yellen. They were pretty good colleagues, so they don't expect that too much in reality is going to change with him.
All right. Well, Powell should be taking over that seat today. So let's see what happens in the course of the year. Thank you very much for your time.